Beautiful. Oop. Sure. Go ahead.
My name is Alexander Kreindler. I'm the founder and CEO of a company called Cortex. We aim to provide access to private market investments such as venture capital and private equity through an investment banking business and a investment management business. Very happy to be here. I'm going to welcome my fellow panelists up here to also introduce themselves, and then we can talk about investments during an upcoming recession. So maybe we can just go down the line here and give everybody a chance to briefly introduce themselves.
I'm Mike Smith from Smith Financial Group. We're in Austin, Texas. I'm the CEO and founder.
Nish Patel, I'm a partner at Inertia Ventures. We focus on early stage investments in prop tech, fintech, and insurtech companies.
I'm Ryan Lloyd. I'm the founder and CEO of Bright Guide Financial in Scottsdale, Arizona, and we are a wealth management company.
All right, thank you. So beginning with the first question, many of the world's most well-known companies got started during economic downturns. Bill Gates founded Microsoft in 1975 during the oil embargo recession. Uber and Airbnb got started during the Great Recession in 2009. As the world emerges from the pandemic, how can investors best position themselves to take advantage of emerging opportunities? I think we can just go down the line.
So, well, I would say that and we were talking a little bit about this before we came up here, the real emerging opportunities in the world in general are in private equity. And I know that's your world there, but with the kinds of things that I put my clients into, we're looking very hard at the private equity space because people don't want to go public until they absolutely have to because of all the regulations. And that seems to be where the opportunities are, as well as technology is not a thing, salt we sprinkle over the top of any investment. It is the investment. So the world of technology is where I tell my clients we need to look there first, and we need to look in the private equity space.
No, totally. Thanks, Mike. I would echo that with no bias at all. But no, look, I think I would say a few different things. I think it's important for investors to think about diversification. I think both across industry and asset class. So, I think a healthy balance of exposure to things in the public equity space, real estate, which we could touch on later too. There's a number of different avenues to be able to participate in, even as a small investor. And then I think, again, I would echo what Mike said around private equity and venture and private investment, having the potential to be able to take advantage of a lot more inefficiency as a function of everything we're seeing in the midst of the pandemic and kind of post-pandemic. So I think being able to diversify across those spheres puts an average investor in a pretty healthy position.
Again, can everybody hear me okay? My mic. I'm not sure if my mic is on here.
Yeah,
okay.
There we go.
The private equity space is a really interesting and up-and-coming opportunity. Bright Guide Financial, my firm, is an independent company, and so you see this shift. The trend really is a lot of advisors are leaving the wirehouse space and moving into the independent space, and a lot of what's driving that has to do with the independence and the creativity and the access that at really at one point didn't exist. And so, enter in these middle market opportunities, which were at one point exclusively reserved for the ultra affluent and the institutions on Wall Street. The investor now who is at that accredited status, but perhaps not an ultra affluent investor, can now access private markets, venture capital, private equity, private real estate, even the private debt space is very interesting. And so what we now have is an opportunity to build a portfolio akin to the way the smart money, the institutional investors of the world have been doing it for a long time. And so one statistic I would just throw out there that kind of blew me away a couple of years ago when I first came across it, 3 or 4 years ago, is that if you look at university endowments, pension plans, again, a lot of larger institutions, as much as 50% or more of the capital under management is outside the publicly traded markets. And so when you look at the level of success and the level of resources and of course the caliber of the investment management on board, it's pretty incredible to see the difference in the way they're managing money and the way the retail sector is managing money. So I'll turn it back to my colleagues here, but certainly private equity. Of course, there's the more traditional things that people could be looking at as we face potentially a recession, right, where we're going to take certain bullish positions in technology. We as a firm really are bullish in specific sectors in technology. Data storage, I think, is a very, very interesting space. I'm curious to hear if you guys have anything to speak to on that. With the level of data consumption and demand that's already here and on the horizon, autonomous vehicles are going to push this thing right through the roof. Data storage centers are particularly interesting to us.
Yeah, no, just chiming in on the tail end of that, I think data storage centers and even just the way that a lot of companies manage their data is changing in really interesting ways too. And I think a testament to your point on some of the efficiency that some of these institutional operators can bring with a private equity approach to investment is really interesting. An example of that is Dropbox, for example. And this is a broader trend that has been happening amongst a lot of technology companies where they are repatriating a lot of their data storage from cloud to on-prem. And there's a pretty material cost savings that can be taken into account as that repatriation happens. And the shorter term migration costs of that tend to reduce margins for companies, which in a public market, publicly facing sphere, that would batter the stock and end up putting it at a discount. Whereas a lot of private equity approaches has been to take it out of the market, not really looking at a quarter-to-quarter type approach and thinking about the longer-term health of the business, which ends up yielding much greater longer-term profit, which is just I think another testament to being able to more efficiently allocate and manage capital and grow a business in a private sphere as opposed to purely just a public one.
Yeah.
So you were asking about what about opportunity in crisis and things like that. That was the original question, right?
Right.
But I think the thing that's so different today is this crisis, at least in the markets, came and went so quickly that we're still looking at all of the opportunities that we were looking at 18 months ago, because the markets are back, in fact, above in many cases where they were then. And we didn't have an ultimately broken part of the economic system. We had a broken part of our health issues that we had with COVID and all. And so there's this opportunity to just continue to move the economies forward and move the markets forward. So that opportunities are just continuing to froth. They're just always there. It's not coming out of, we've battered the market, it's, the world is down and now we're looking for things to take us back up. We're still at those higher points.
So Ryan, you touched a little bit on this, and you as well, in terms of data storage centers, certain businesses that are well positioned maybe to emerge stronger from the pandemic than potentially other businesses. Can you discuss a little bit how to think about which industries or which business models might be best positioned to actually see explosive growth coming out of the pandemic?
Well, I think the low-hanging fruit here, to just take a quick segue, is probably the hospitality industry. I mean, we're sitting here in Las Vegas, and nobody was going to Disney last year. Nobody was going to Las Vegas and attending conferences last year. People weren't going to the movie theaters last year. So I think that now that a lot of the restrictions have been lifted, and we're seeing people open up economies, governments opening up the economies, we're going to see a lot of travel influx. And of course, there's a lot of opportunities there where some of these individual companies or even specific ETFs are still down as much as 25 to 40%. So, looking a little bit more short term, I think that there are some opportunities there. I would also, mentioned that multifamily housing, we were talking a bit about real estate in the housing market. Supply is low in a lot of these metro market areas. Interest rates are low, so it provides an access point for people to come in and buy a home, a larger home. And so when you have demand this high and the recent spike in inflation, there is this interesting recipe for probably short and long-term appreciation and healthy yields coming out of the real estate market.
Yeah.
Yeah, I think your greatest understatement was that housing is a little low right now. My gosh. I live in Austin, Texas. If your house didn't get at least 20 offers on it when you put it on the market, you just weren't trying. It's just been out of control for months on end now.
Yeah.
Now, that'll come to an end eventually, but it's not overly foreseeable at the moment. Housing is going to continue to be, in every form, is going to continue to be a strong, strong play for the future.
Yeah, and I think I think generally real estate as an industry is one that hasn't traditionally felt the need to evolve or adapt to new trends or technologies. The culture's been very about the status quo, but I think in the onset and coming out of the pandemic, everyone is rethinking what it means to live, to experience things, to work, and I think some of the uptick you're seeing in volume and in demand for multifamily housing, single family housing, all asset classes, which have done really, really well, is partially a function of, I think, the world's changing perspective on what it means to work. There's been kind of an adoption amongst a lot of corporations we've talked to of a hub and spoke model where a lot of front office workers are going to remain in their New York, SF, LA, Austin, wherever their headquarters are, and then some of the middle office and back office folks can be relocated or take a more remote first approach, which allows them the opportunity to invest more in their housing where they live. Are they going to buy more furniture? And so you see furniture companies doing really, really well, randomly. And then I think the other piece you see on like the retail side has been the emergence of ghost kitchens and food delivery. Uber Eats or DoorDash or some of these delivery services have seen tremendous revenue growth, tremendous demand growth, and that's interplaying into the way that a lot of retail is even structured. So I think broadly, like real estate has been an industry that has lagged in productivity and efficiency growth for decades. That's now starting to catch up really quickly to the new cultures and new ways of life for a lot of people, and I think people are rethinking communication in general. So the other subset is communication tools for people to be able to remotely coordinate with one another and maintain and kind of boost productivity.
So Ryan, I'm glad you touched on interest rates. The central banks of the developed world seem hesitant to raise interest rates, I think, in an effort to keep their currencies competitive. And now the Federal Reserve is indicating that there's an inflation risk and they may raise rates sooner than expected. So how can investors protect their portfolios in an environment where we may see long-term low interest rates for a while? We may actually experience some inflation. How do they hedge those risks?
Yeah, it's such a loaded question, and there's so many ways to answer that. I would say, we agree that interest rates will remain low for a while. I mean, it would almost be contradictory to think otherwise, given the stimulus and some of the things that the federal government has done to try and reactivate the economy. They have whispered, though, in their most recent meeting, the Fed, that they may hold back or stop buying back approximately $140 billion in bonds. So there may be some minor course corrections on the horizon, but it's totally speculation to know when they will change interest rates. But most of the institutions that we communicate regularly with think that we're 2022 or beyond 2023 before we see any major movements. There are the more traditional, tried and tested things that we can look to, Treasury and tips. We can look at REITs that tend to do well when inflation rises. I think that looking again at the alternative investments and potentially cryptocurrency, potentially the non-traded and private equity markets are an interesting place. And then, whether we get to insurance or not as a topic, that's also a very interesting and broad topic as to sort of reinventing how we design and allocate a portfolio where for decades it was equities, fixed income, cash, and those were the three spokes of the wheel. And now we have this opportunity to allocate to the private markets, which is potentially a large portion of the portfolio in some cases. And then we have alternative or insurance assets, which have continued to evolve, become very competitive. And when we look at insurance as a potential bond alternative, where thinking long-term, as hopefully most investors are, where we can see 4 to 5 to 6% internal rates of return with a lot of other additional beneficial characteristics that bonds don't have. There are a lot of very smart people that I talk to that are looking at combating inflation and picking up some additional benefits by utilizing insurance as a partial replacement for fixed income.
Yeah, no, I think that all makes total sense. I think the worst thing that someone can do is hold too much cash at this point in time, because just with the amount of money that we've been printing, the way that flows back into the financial ecosystem inflates all assets. To Ryan's point, we're not going to necessarily feel the inflationary effects for 1 to 3 years. I think the best thing to do is to allocate your assets in a way, and also not necessarily shy away from debt, given how low the interest rate environment is. So, and I would caveat that I think debt is, especially at some of the levels that we're seeing, pretty healthy. But I think there's also a subset of the market that can misinterpret that and then become speculators, and you see that play out in the public market ecosystem, where there's communities around these forums that can pump stocks like GameStop. Or crypto assets like Dogecoin, and in ways that don't follow any sort of fundamental trajectory. And then if someone is over levered and ends up buying high and selling low and being caught on the wrong end of the stick and getting margin called, then they get that they get a rude awakening. But I think in general, I think the traditional 3-spoke model of fixed income, equities, and cash is outdated and I think irresponsible to a certain degree. I think there's definitely been a huge push for a need to be even active in portfolio management and think about how we're taking in new data points every day, every week, how these different trends that are changing at breakneck speed can alter your investment positions, and making sure you're cognizant of some of these changes and safeguard yourself against that in a way that allows you to put the most capital to work as possible.
I'll just, if I could, speak to one more point. If you look at some of these private institutions that are raising capital and acting as, in a sense, a bank or a lending institution without all of the regulation that surrounds traditional banks, they're able to oftentimes come in at first position, but in more cases than not, second or third position, mezzanine levels, where they're able to lend to private middle market companies. And when we say middle market, these are companies that are doing $100 to $1 billion a year in revenue. I mean, they're large companies, but small in comparison to the behemoths on the exchanges. The default ratio is extremely low. And so you look at the scope of risk relative to the yield, and oftentimes these companies that have exhausted their options with traditional banking and lending methods are able to secure capital from these privatized banks, unofficially banks, and they're willing to pay 7 to 12% in some cases, which can provide very attractive yield for the investors as the end result. And they're also able to put some things in place which provide investors additional security, such as they can go and sit in on the board meetings, they can collect all financials. So they know early and often if the companies that are borrowing run into trouble. And so that really creates a much higher degree of security, and they retain those loans a lot of times rather than selling it off. So with that skin in the game, they're really looking at the borrower a bit more scrupulously, and I think that's a very interesting and growing space.
I would agree with you guys about the three-spoke model is totally outdated. But to be practical for just, very, hands-on for just a second, there's two things we've been telling our clients right now. One is, as they worry about inflation and those things, which we'll see how much of that comes to pass, is that this is a time when you have to kind of lean in on inflation. So looking to some of these things that are maybe just fixed income type of things, corporate bonds and debts like you were talking about, where you can buy into these private lenders and they don't carry the risk that they did 30, 40 years ago. And they're a great way to be able to just get, 7, 8, 10% every single year out of those kinds of things. And we've also been telling them, look, we need to move a little bit more towards some birds in the hand, if you will. So things that we're not buying waiting for growth to happen, those things are certainly available out there, especially in the alt space. But also, we want to maybe bring up or beef up a little bit the things that are going to pay us every single quarter, every single month, so that we've got cash on hand should, depending on which direction inflation and those kinds of things go, that we can either reinvest or we have more money available to us should things get ugly and we need to have money. So I think that the alternative space, which is an area that my firm has a ton of expertise in, I think it's become the new area that we replace bonds completely with, because this becomes the place where instead of getting 1, 2, 3% in municipals or other kinds of things, we're getting 6, 7, 8% or more sometimes in these areas. And clients look at that and they go, okay, that's more in line with what I want. That's more in line with what I need. Everybody, I think, is in the position where they're going, I want to make money now because I have no idea where the future goes right now. So let's make money now or position ourselves to have some reliable streams of income for the next 1 to 5 years. And then we'll hope that the world kind of sorts itself out, which it hopefully will over this next year, because we're in crazy times here right at the moment with economic data and everything else. And we'll be in a better position to go, okay, a little more normal times, let's make some other decisions now.
All right, maybe we can talk a little bit about alternatives. We've talked about private equity a little bit, we talked about insurance products, maybe adding to that venture capital and also cryptocurrency assets. How do you think those fit into the average investor's investment portfolio, especially now in the context of the current environment?
Well, if I can just jump in for 1 second here, because alternatives are what we do. And I always caution everybody, alternatives is a very large category and takes in everything from my brother-in-law's West Texas oil well fund to companies like Red Oak Capital and others that are highly capitalized, incredibly stringent lenders who pump out a really good return all the time. And so you can't just go, well, give me some of them their alts, you can't approach it like that. We find that we have to do a ton of diligence as we look at these alts and bring onto our platform the ones that we want to use. So, I don't know about you guys, I'm sure you have the same experience, but alts ain't just alts. There's a lot of variety there, and some of them you better just run like crazy from.
Absolutely. With the introduction, this isn't brand new stuff, but I would say the level at which it's become available to the
really commonly
market
available
has increased a lot in the last decade or so. And of course, with that, there's some bad actors out there. And so sort of buyer beware and certainly working with a credible firm that understands how much due diligence is required. And so, we would look at a very long list of criteria to make sure that it's the right fit. But they are, but there are some really attractive opportunities out there. I wouldn't speak to crypto so much. As a firm that really adheres to more of a tried and tested asset allocation theory, we can get very customized, but cryptocurrency, I think, sort of off the record, I think it's probably going to go somewhere. If I had to speculate, I'd say that maybe at some point there's some consolidation and a lot of these coins don't make it, but are maybe consolidated and there's 1 or 2 primary leaders. But it's still very, very difficult to understand blockchain technology is an incredibly sophisticated technology and the applications therein. So I don't typically, our firm doesn't typically provide advice specifically on, should you buy this coin? How much of this coin should you buy? I'd call that the side account where it truly is speculation.
We give advice, and our advice is don't buy it.
Yeah.
All right,
That's our advice.
I'll take the opposite approach, then I'll play devil's
ahead,
advocate
do it.
here. I spent a little bit of time in the digital asset space, so I can speak to what I feel like is attractive about the asset class and why I think a retail investor, just generally investors, should have, I would advise, something like 1 to 3% of their net worth in a digital asset, and I'd really just say Bitcoin. I would say this because, again, to some of the prior discussions we had, like, we are in the middle of the biggest fiscal and monetary experiment in history. Like, we've never done what we're doing now. I was just mentioning, we have printed something like 40% of US dollar money supply in just the last 12 months. Like, that's something that's would have otherwise been unheard of. And I think because we don't really know the inflationary effects and how they're going to play out over the course of the next few years, diversifying into an uncorrelated, sovereign-free asset class that is trackable, is minted on a deflationary curve and mathematically programmed to be scarce is something that I think used to be very appealing to people that lived in maybe some South African countries, maybe or South American countries, some African countries where they're run by monarchs or dictators that have hyperinflationary policies, and this is a good hedge of being able to get out of that. If you're in Venezuela and you put your money in a Bitcoin, like, you won't lose it. If it's in the bolivars, that it's basically gone. And I think, and the thing I would kind of compare it to is a digital gold, and the reason that and Bitcoin specifically, and the reason that I feel for that is, my parents, my grandparents, they have physical bars of gold, like in a safe, like they have actual bars.
Where exactly?
Here's the PIN number. I'll run it up. And I would never buy a physical bar of gold. I mean, it would be cool, but like, I wouldn't want to risk losing it or holding on to it or whatever. I'll buy gold. I'll buy commodities. I'll buy an ETF that gives me exposure. But I think the same paradigm shift between my grandparents' generation and my generation is a similar paradigm shift between my generation and I think future generations that'll come, that I've had conversations with a lot of intelligent young people where they're like, why do I need to buy gold? I'll just buy Bitcoin because I look at that as my safe haven, kind of inflation protection asset. And all you need is network effects for something to take off. So I think that's the devil's advocate to crypto and Bitcoin.
Yeah.
But yeah, I would certainly bifurcate between crypto assets and then the technological application of distributed ledger technologies. And I think there's a lot happening in the DeFi space that is a threat to the Visas and MasterCards of the world that charge interchange fees. A lot of that is going to get disrupted by DeFi and some of the other movements in crypto. But I would also kind of separate that from the way I akin a Bitcoin to a digital gold as a safe haven type asset class. So I wouldn't say put all your money in crypto, but I would say put some of your money in crypto.
So everything you just said about cryptocurrency and all those kinds of things, if I trotted out that in front of every one of my clients except for one, they would go, what?
Totally fair.
So I guess it gets back to the buy what you know, and if you were, and I'm not trying to make anything light of this, but if you were working for me, I'd go, we're going to buy some crypto, and he's the guy you're going to talk to about how to do it because he knows everything there is to know, at least at our firm, about that. I feel like cryptocurrency in all of its various forms is kind of like the computer business back in the 1980s. And all the people who are winners today in the laptop and desktop categories and stuff they weren't even existing, or they were footnotes. I mean, back in 86 or so, I would have said, oh, Northgate, Xeos, Commodore, TRS, those are going to be the winners. None of those exist today. People don't even remember who and what they were. I feel like crypto will have a big sorting out coming, and it's just too hard right at the moment to be able to go, I think these 10 people are the winners when there's 100 plus platforms.
Yeah.
So that's my only But hey, I'll call you and we'll invest.
All right, we have a few minutes here. I'd like to open it up to Q&A if anyone in the audience has any questions.
I think I see a hand up there.
I can't see a thing.
Yeah, I'm blinded by the light.
Yeah, I think they might bring you a mic.
Here he comes.
Right behind you. Yeah, I think it was right here.
Yeah, he's trying to get it on.
Oh, okay, cool.
Thank you. Listen, you guys have done a good job with the way that you've articulated, and obviously, in my observation, you're the VC guy, I think.
I'm the
You're
VC guy.
Okay, you're the PE guy. PE, VC, all that good stuff.
That kind of thing.
And then you're the alts guy. And
If you're pointing at
you
me,
are
yes.
the holistic, comprehensive guy, because the way you've articulated your vantage point, it's informing, and you talked about the different asset classes and all the different things that you're now incorporating. I'll tell you what we call that when you're incorporating things like insurance and alts and so on. Your foundation is modern portfolio theory. And when you incorporate insurance and stuff like that, in my world, we call it modern portfolio theory plus, because now you're talking about how you're managing and you're replacing bonds with insurance strategies and things like that. Now, the thing that I don't know if it was very well addressed is the objective of this particular session, which is a guide to investments amidst the widespread fears of a recession. And maybe the takeaway in what you guys have tried to articulate is you need to be properly diversified. You talked about accredited investors. You guys talked about alts and all that stuff. Part of this whole thing, though, is in order for you to participate in alternatives, you got the Reg Ds that you're dealing with, and, because you got to be accredited in order to kind of allocate some of that capital.
That's not true.
Well, alternatives are different. It depends. You've got a very broad spectrum of alternative investments that are out there.
you do.
Okay. And when you're dealing with private stuff, private capital, private, all that, there are regulations and there are different categories. We
That's
have
correct.
what you call high net worth investor light.
Right?
Yeah.
Okay. So that
But
may be.
my only point was, and I didn't mean to cut you off, but was just that you don't have to be an accredited investor in order to invest in alternatives.
Those are the lights. That's what we call those folk in that space, and the interval funds and all that kind of stuff. But the point I'm making real simply is, I think the message that you guys are trying to articulate is proper diversification. I do agree with you that cryptocurrencies is evolving. I am of the position, obviously you guys are very compliance driven. That's why your compliance people are not allowing you to do that. You guys are living in the alt world. I am of the opinion personally that you need a small systemic allocation to cryptos. Systemic in the sense that you got Bitcoin going to 60,000 and coming down to 30 and all that stuff. If you're making systematic investments, but it's a very small allocation. That's what we're advising our clients to do. But great job, guys. It's really about proper diversification, because that's what's going to keep you continuously invested in a recession, which I believe is the whole what this is all about. Yeah. And you stay invested and not do any market timing, because you don't want to miss out on those opportunities where those runs begin to happen. Good job, guys.
Thank you.
Thank you.
Thank you.
So maybe just in the 30 seconds here, I think one of the reasons we didn't spend quite so much time on recession is I'm not so sure that those of us up here are going, hey, there's a looming recession. I'm not sure that I see that
I
point.
did have more questions that were
Yeah.
recession focused, but just given what you were addressing in terms of alternatives, I thought it would be make more sense to focus on some of that.
Yeah, and look, I think, you can make the argument that in 2020, there were a few quarters where we were in an actual recession and we actually didn't know what the other side would look like, but I think what we've actually seen come out of it is the economy's been really strong, demand's been super strong, Unemployment is so low that it takes me like 15 minutes to get an Uber anywhere. So I think there's definitely been some areas that have faced a recession, but I think concurrently there's been strong growth and strong demand in so many other areas. It's hard to really think of us in an environment where there's a looming recession.
I think
Certainly
this,
not
I
in a
think this
traditional
topic was initiated last year.
Yeah.
and certainly we all had a different gauge on what
Yeah.
was to come last year. So are we out of time though?
Yes, Ryan, Nish, Mike, thank you very much
Thank
for
you, guys.
the discussion.
Thank you.
Thank you, man.
Pleasure. Thank you.
Thank you, everyone.